Hi, everyone. Welcome to today's webinar. We're glad you could take the time to join us today, and we want to thank you all for listening in. During the presentation today, I want to invite you to ask your questions, and we will do our best at the end of the presentation to answer just as many as possible. My name is Adam Rauscher. I'm a Senior Financial Advisor here at Biltmore Capital. I'm joined today by our presenter, Dr. Donald Chambers, who is our Chief Investment Officer of the Biltmore Select Managed Account Portfolios. The topic for today's discussion is market volatility and the opportunities that are created in such volatile times. As everyone who is listening today knows, we have had an amazingly volatile stock market as of late. The shutdown of economies around the globe, combined with major oil price declines, have had a swift and decisive effect on our markets. And that effect has not only been felt in the stock market, but also in the bond market as well. As an advisor here at Biltmore, I can tell you that we're always on the lookout for opportunities for our clients and for ways in which we can add alpha to our investment portfolios. Oftentimes, some of the best opportunities comes in times of uncertainty, as uncertainty can often, just as it has recently, be a primary driver behind market volatility. What we're going to discuss today are opportunities in the closed-end fund markets specifically. Don will take us through what closed-end funds are, how they work, and how we identify opportunities in the space. For those of you who are longtime clients, this will be an important refresher course on the strategy and how it works. For those of you who are new to Biltmore and our strategies, this is a space where we believe we can gain a strategic advantage and capture inefficiencies and mispriced assets when they are effectively on sale. These are strategies very few market professionals discuss, and it is one of our core competencies as a firm. I often ask my clients, when would you want to order an expensive new item online? Would you want to order it the week before Thanksgiving for full price? Or wait till Black Friday when it's going to be 50% off, knowing that the following week it will likely go back to full retail price? Well, unfortunately, the markets don't give us an annual Black Friday sale. That would be nice to look forward to, but it does give us unscheduled sales from time to time, and that's what we want to take advantage of for our clients using these strategies. Now, without further ado, I'll give the floor to Dr. Chambers and have him explain in more detail. Don, the floor is yours.
Well, thank you, Adam, and thank you, everybody, for joining the webinar today. I'm going to try to explain what closed-end funds are and how they can be used in various market situations. And that concept begins with net asset value. And that's what I've got up on this first slide, is that the net asset value is, and I put this in quotes, the theoretically correct value of a mutual fund. And by that, what I'm saying is it's our starting point, that if mutual funds didn't have fees, and if we lived in a perfect world of no taxes, then mutual funds would trade at their net asset value all the time. Then we're going to try to talk about why there's opportunities to buy or sell funds when the actual value price of the fund deviates from these theoretical values or net asset values, and how the relationship between net asset value and price can be used to better manage your wealth. So let's start out. The theoretical value, the value if there were no frictions or expenses or taxes in life and everybody was on following the market continuously and trading quickly, would be the price of each fund. How would we find that? Well, we take the total amount of assets that the fund owns, whether it's stocks or bonds or preferred stocks or whatever it is, and we divide that by the number of shares that the fund has issued. So for example, if a fund has $500 million in stock or bonds or whatever, we take out any debt that they might be having, any leverage that they might have. So we want the net assets, and let's say this fund has no debt. So it has $500 million in assets using the market price of those underlying assets. And it has 20 million shares outstanding. then we would simply say, well, each share has a pro rata ownership of that $500 million. So each share would be worth $25 per share. So we total the values of every security or asset held inside the mutual fund. We subtract out any debt that the mutual fund has incurred in building that portfolio. And then we divide that netted value by the number of shares outstanding, and that tells us the per share value. And in a theoretical sense, if we ignore everything else, at any particular point in time, that should be the value of each share. And that's the theory. And what this webinar is going to be about is the actual reality of how these things trade in the marketplace on a daily basis. So let's talk about three major types of mutual funds. The first are what we might just call a regular mutual fund, or more technically an open-end mutual fund. And that's the traditional old-fashioned mutual funds that became popular back in the 1960s and are still very popular to this day inside of retirement accounts. They've been issued by firms like T. Rowe Price or Fidelity or American Funds and Vanguard and others. And you buy and sell these funds, whether it's through a broker or directly with the company on a nightly basis. And that's the exact value, the net asset value that mutual fund company uses to issue new shares if you're buying shares, or to redeem shares if you're selling the shares back to the fund. The other type of mutual fund is second type is an exchange traded fund. They've become enormously popular in the last 20 years, and they are great vehicles, and they trade in the marketplace just like a stock. So I list some ticker symbols here of the three biggest exchange traded funds. SPY follows the S&P 500, and you can buy that and sell that on the New York Stock Exchange just like you were buying or selling a regular share of stock like IBM. And then there are what we're talking about today, emphasizing today, the closed-end funds. And just like the exchange traded fund, they can be bought and sold on the exchanges, the New York Stock Exchange mostly, some NASDAQ, just like you buy and sell exchange traded funds, or that you buy and sell ordinary shares of stock. So we're going to talk about all three of these types of mutual funds. And as I said, the first two types are very popular. This third type has been around for many, many years. I've traded it. I started back in 1978 or 1979, both personally and professionally. And they've been around for all these years, and there's a lot of them out there, but a lot of people have never heard of them, or if they've heard of them, they really don't understand exactly what they're about, and that's a lot of what this seminar is about. So let's think right now about these traditional or regular open-end mutual funds. And we want to think about the idea of what their net asset value is each day, because that's what you can actually buy and sell the fund at. Now, these are real prices of the Vanguard Total Stock Market Index Fund Admiral shares I'm listing down here. This, I believe, is the largest open-end mutual fund in the world, and it's showing a reverse kind of chronological order here. At the bottom, we've got March 13th, and there's only one value listed. If you see open, high, low, and close, that's because this format was set up for a stock market traded asset. These are not stock market traded. There's just one price all day. You put your order in, whether you put it in at 6 o'clock in the morning or 3 o'clock in the afternoon. They usually have a cutoff time of around 2 or 3 o'clock. And you put in your order if you want to buy it or you want to sell it. And at the end of the day, literally 4 o'clock and at the end of the trading day, they calculate the per share net asset value, and they calculate it as $66.14. If you placed a buy order for that mutual fund, they will buy you in at $66.14. If you placed a sell order, you have some existing shares that you're redeeming, they would sell you out at $66.14. Now that's a pretty good mechanism, but you can't make any trades during the day. It's at the end of each trading day. They process it overnight, and the next day you effectively own that asset. And if you see on March 16th, it went down, and it goes up and down, and every day you get to buy and sell. Those mutual funds are popular. They're especially good in retirement accounts, but it's not what people are finding very useful to trade nowadays. What people really are trading a lot nowadays are exchange traded funds. If you look up at the top of the screen here, I've got the ticker symbol here of SPY. This is the biggest exchange traded fund in the world. It's following the S&P 500. And what I've got on this graph here is a one-day graph. This is just one day, March 25th, of the dark blue line here is the actual market price on the New York Stock Exchange as it traded all throughout this day. You've got a volume bar down here, and you can see there was tremendous volume near the end of the day here. But it shows the volume and it shows the price, and the dark blue line is the actual price of the ETF. And the light blue line is the actual reported value of the index, the Standard & Poor's 500, that this huge exchange traded fund tries to mimic. And what you see here is this incredibly tight relationship between these values. There's times when you can see a little bit of distance between them, and you wonder to yourself, well, why is it trading so closely all day long on a rather volatile day here to its underlying theoretical net asset value? And the answer is because there are computerized traders with computer systems that are looking for just a glimmer of a distance between these two. And if they become apart, like I'm circling here, they're going to sell or short sell this dark line, the fund, at a higher price, and then buy an exposure maybe through the futures market on the S&P 500. So this is called arbitrage, and a lot of people think that this computerized trading and arbitrage is ruining the market. But here we see a tremendously valuable service that it's providing. It's forcing these exchange traded funds to trade remarkably close to their underlying theoretical value, the S&P 500. And this is why these exchange traded funds are so wonderful. We use a lot of them at Biltmore Capital to manage our clients' money because they're very, very low cost. And because we know that when we buy and sell these, we're getting the theoretically correct value for these shares. So most of our clients' money, I would say most of it, is in these exchange traded funds, where arbitrage all day long forces the market price of these funds to equal their theoretical value. The expense ratios most of them are less than 10 basis points per year. That's 1/10 of 1% per year. This is a remarkable innovation. By the way, I'll just back up 1 second here. That when I said that you can buy and sell at these net asset values for the open-end funds, that's if they don't have any loads. If they have sales loads, then when you buy it, you pay a different, there's actually a higher price and a lower price where they're doing a sales charge to be in these funds. Nowadays, most of these funds are no loads, and they can be a very cost-effective way to manage money well if you buy something with very low expense ratios. Those are the two major types of funds so far. But I want to show something that happened in the crisis right now, if I can get it going the right way. Sorry about that. This is another exchange traded fund, but instead of it being the exchange traded fund of the S&P 500, it's a huge two huge municipal bond ETFs. One of them is MUB, which I think is an iShares product. I'm not sure. And then the other is VTEB, that's a Vanguard product. Now, both of these ETFs, you might see I'm circling them in the upper left-hand corner here. Both of these exchange traded funds are offered on the New York Stock Exchange for people to get access to a very well-diversified portfolio of municipal bonds. And in ordinary times, as you can see on the left of this axis here, diagram here, they trade very close to each other. And we would expect them to trade very close to each other because they're both mimicking the same index. But a crazy thing happened on this day, this is not from March 10th to March 26th. That's just a legacy entry. It's actually March 26th, and it's during, I'm sorry, this is over this interval. I apologize. I'll show another chart later. And it shows that when we get down to March 19th and 20th and 23rd, there's a huge difference that occurs between these two. They're lockstep together through here, not quite through here, but this is with the financial meltdown. And it was not just a financial meltdown in terms of stocks going down in value. It was a financial meltdown in terms of credit capabilities, and people began to panic that they wouldn't have the liquidity. It was a liquidity crisis, that they wouldn't have liquidity to manage their portfolio correctly. That caused tremendous market disruptions. And here we see it with a gap of almost 3% that occurred during the crisis. And this is setting the stage for what I want to talk about with closed-end funds. There's a purpose for me going through this. So what's the moral to the story here? Well, ignoring sales charges and things like that, open-end funds track the market, but it only gives you liquidity once a day. The exchange-traded funds give you great liquidity in most market conditions, but in a crisis, you get this divergence that can occur between their values, or between their values and the values of the underlying index. And that brings us to the closed-end funds. Now, the closed-end funds are like the exchange-traded funds in that they trade all day. So this light blue line that you see over in the left graph here, the top line, is this darker, looks like a black line, is the actual market price of a closed-end fund. And this particular fund is called BTT. It's a BlackRock municipal bond fund that we hold for our clients. And this lower line shows that the price that it traded over the past year. This is a 1-year chart. And the line above it is the market price, is the net asset value. And the question that we're going to be addressing through the rest of this webinar is, why is there a difference between the net asset value and the market price? This fund is trading at a discount from its market price. Now, why would it trade at a discount from its market price? Well, that's what I'll be talking about in the next slide. But when the way that we talk about this, if you look at this diagram right here, it's really hard to see in this time right here, which was the recent financial crisis with the recent bounce. It's hard to really see what the distance is vertically between these points. So that's what this diagram over here does. This is 0, and this is a 5% discount, a 10%, 15% discount, and it shades this. We really just want to follow this line right here. This line right here is the distance between the net asset value on top and the price on the bottom. Because the net asset value is higher, we know that this is selling at a discount, and the discount is below the axis here. On some funds, they sometimes trade at premiums. I'll show you one, and we'd have it going up above this 0 axis. So this fund trades at a 10%, maybe 9% discount for most of the time leading up to the financial crisis. What that means is that you could buy for $89 or $88 or $90. You could buy $100 worth of bonds inside of this fund. This is what the discount is all about. You're able to buy the economic power of $100 worth of municipal bonds for only $88 or maybe $86, for around $92 here. I was saying that wrong, I'm sorry. So you could buy these $100 of bonds for maybe $92, and when you get over here, you could buy it for maybe only $88, or down here, maybe only $83. So why would you be allowed to buy a fund that's worth supposedly $100 for only $92? And that's why I use the word theoretical value when I talked about net asset values, because that value of that fund, that net asset value, is before the fund's expenses. When you take into account the fund's expenses, the management fees and other expenses that they have of operating the fund, the shareholder of these funds, you and me, the investors, are receiving the returns on the underlying assets net of all those expenses. And because those expenses can be large, these funds tend to trade at a discount. So while as with an ETF or an open-end fund, you'd say that the net asset value and the market price should be locked together very close to each other, in closed-end funds, they differ. And the valid reason for them to differ is because the fund has expenses. This BlackRock mutual fund, and we like this fund, this BlackRock mutual fund has a lot of expenses. And when you take into account those expenses, this thing should be trading at a discount to reflect the fact that the sponsors of that fund are taking fees out of that before the money comes to them, before the money comes to us as shareholders. So the real question becomes, well, how big of a discount should this be? Even though they're taking out fees, if you could buy this at a 30% discount, it would clearly be wonderful. You'd be getting the returns on $100 of assets with only having paid $70. But if this thing has almost no discount, it probably wouldn't be attractive. So what should the discount be? And the answer is it should be based upon fundamentals. What do I mean by being based on fundamentals? And I mean, it should be based upon things going on inside of the fund, economic realities, such as the amount of fees that they offer. So is that what drives these fund discounts? And the answer is partially. Their expenses play an important role in determining what the discount is. But we find, and I'll show you on the next slide, that the discount tends to vary through time. Well, the fees aren't really changing, the expenses aren't really changing. So what's causing the discount to bounce up and down? Even if we, if we go back to this diagram, we see that the discount got huge during the crisis, and it got pretty small before the crisis. So what's causing that discount to go up and down? And the answer is supply and demand for shares in the market. That's kind of obvious that it's people buying and selling the fund. Why do they buy and sell the fund? Part of it is investor sentiment. People get very excited and enthusiastic and they bid the price up. They get very scared and it bids the price down. Another thing that happens is that the investors in these funds, like our clients, sometimes need money because they're, for instance, paying their college tuition for one of their children, so they have to sell some of their shares into the marketplace. Or maybe they're buying new shares because they have extra money to put into the strategy like closed-end funds. So that's why I've got investors' liquidity needs here, that maybe around tax time or something like that, people are buying and selling these funds. And when the supply and the demand get out of balance at the existing price, the price has to go up or down to meet that supply and demand. So long story short, we see that some of the movements in discount simply by, if I go to the previous graph here, oops, sorry about this, I'm not running this very well today. When we see these little changes in the discount here, that's probably just because people are buying and selling the funds, and it moves the price a little bit. But what I want to show next is the strategies. We can buy and hold the funds and not speculate on whether the discount's going to go up or down. If you can find one of these an attractive discount rate and buy it, then you should do it and just hold it. Because if you can purchase the right fund at a discount of, let's say, 15%, then you're getting the returns of $1 by only paying 85 to 90 cents. And if their fees are low enough, that can be a fantastic long-term strategy. Another thing that we can do is we try to trade between the closed-end funds, moving in and out based upon these movements in the discount that I've been showing on the diagram. So let's go to a more interesting picture here. Now this is I think about a 26-year diagram of the premiums or discounts in the closed-end fund called MPA. It's a municipal bond fund out of Pennsylvania, and it has a long-term history, and I've traded this for my personal account. It's something that should be purchased primarily by Pennsylvania residents, and I used to be a Pennsylvania resident, so I invested in this fund. And if we look at its history, it comes out, it trades at a big discount. Why? Because you shouldn't buy it when it's initially issued, and people do, and then they sell it, and it drives down the discount until we get investors like us who are smart and pick it up at a big discount. And then it came up to this huge premium, and you might ask, well, why was it selling at a premium? And I'd say it shouldn't have sold at a premium. It should not have sold at a premium like this up here. It was ridiculous. But you can't short sell these things, or it's very difficult to short sell these things, those of you that are familiar with that concept. So really, it's a question of buying when it's attractive and getting out when it's no longer attractive. This is the late 1999s, and you may remember the stock market was certainly for growth stocks was going up and up and up, and people were getting enthusiastic, so it went here. Then the stock market crashed, this tech crash, and the discounts became huge. And then the stock market recovered, and then this is the big crash of the global financial crisis, especially getting into October of 2008. And I remember trading this fund, I believe it was this fund or a very similar fund, during the financial crisis when the discounts got up above 20%. Now, if you can buy this at a 20% discount and hold it for the rest of your life, you're going to do fine. But when you buy it at a 20% discount and its discount goes way back up to 5% or less, the strategy can be more active. It can be, well, I'm going to get out when the strategy is here, and I'm going to bide my time for maybe a year and a half with regard to this fund, and I'm going to buy it if it gets back up to here, or maybe you'll wait until it hits 15%. That's the timing strategy of going in and out. Now, Biltmore is not a stock picker, and it's not a market timer. And you say, well, isn't this kind of like stock picking because we're trying to buy when the discounts are huge and get out when the discounts are small? Well, first of all, these are not really stocks. These are mutual funds. So they have a huge underlying portfolio of hundreds of municipal bonds. So although this is a Pennsylvania only fund, we tend to buy national funds that are very well diversified across the whole country. So it's not like we're picking individual bonds. We're picking a bond fund. And is it market timing? Well, it's not so much timing the market, although it is correlated with the market. It's really comparing this discount with what we think the discount ought to be. And that's the key thing to be able to understand these closed-end funds well enough that you know what the central tendency is. Now, this mutual fund's been around for 26 years, and it looks pretty clear that its central tendency should be around 8 or 10%. Well, I don't think it's an attractive buy at 8 or 10%. I wouldn't buy this at 8 or 10%, even for a long-term strategy. I think you want to buy this at a double-digit discount. But certainly if it gets up to a 20% discount or even a 15% discount, I think it's a real buying opportunity. So this is the strategy. As I said, we can buy and hold some of these things, and we're very comfortable holding them for quite a while, or we can actively trade them. You might ask, why would these things ever sell at a premium? And I think the answer almost always is that people are just making a mistake, and there's really not a short selling mechanism that can offset that. There are some mutual funds, closed-end funds, that have consistently sold at a 40% premium, and there's really nothing you can do about it in terms of taking advantage of that. But this is the sort of pattern that we see long-term in a lot of funds, and that's what we're trying to take advantage of. So a sophisticated closed-end fund strategy, we need to know, by a sophisticated strategy, I mean the strategies I've just been talking about, we need to know that they will perform very poorly temporarily during periods of high market stress. Now, why is that? Well, it's a double whammy. If we go back on this, when we look at what's happening here, if you bought this closed-end fund when it was trading in a normal range and it went down to a 30% discount, there's a double whammy occurring here. The first thing is that your fund goes from trading at 15 or 10 or 15% of its, at 85 cents in the dollar to trading at 70 cents on the dollar. That's a huge loss, and you can't always get into these things at exactly the right time. So when the markets really panic, you take a huge loss. The good thing you know about that loss is that eventually it's got to come back. The second thing to keep in mind is that when you're taking this loss, it's when the underlying assets are also down. So you've got the underlying assets are falling, the discount is widening, and you need to know that most closed-end funds are substantially levered. they take your $100 and they go out and borrow another $40 or so to invest in these securities. Now, we think this leverage is very attractive because they're able to finance these things on very good terms, especially the municipal bonds, but it adds tremendous risk. So getting into closed-end funds, these things are very risky, and you have to prepare yourself emotionally for the idea that, at the very worst time, you're going to be hit with triple whammies. The market's down, it's levered, your funds are levered, and the discount has widened out. So we don't want to get into these things at premiums. We don't even want to get into them at small discounts. We want to get into them at large discounts and have the patience to weather the storm, because we can't be sure that the underlying assets will come back quickly, but we know that the discount will unwind rather quickly. So the period of stress will eventually end, but it takes patience and it takes expertise to know when to get in and when to get out, and patience to be able to weather the tremendous emotional toil of getting in at let's say a 12% discount, and then having a crisis occurs that drives it to a 20% discounts. Holding closed-end funds with large discounts will offer long-run opportunities with great returns. Now, why do I say that? If you buy a closed-end fund at a 15% discount, then you have purchased $100 of assets for only $85, but you're going to get the dividends and the capital gains on the $100, even though you only paid the $85. So as long as that discount is big enough to more than offset the expenses of the fund, the management fees of the fund especially, then these are going to give you long-run attractive returns. And you can add on top of that long-run attractive firms of buying these things at a discount, the potential to be able to trade in and out when we get some extreme movements in these discounts. So that's it. I know it may sound a little complicated. I hope I've adequately warned you about the risks, but adequately let you know that I've been seeing these opportunities going on for, as I said, I've been trading them for over 30 years, and the opportunities are not as good now as they were back in the 1900s, but they're still very attractive at certain times. And if you're patient and if you know how to do this, you can add value. So I'm ready to field questions, and I hope I was clear on these issues. Thank you.
All right, great. Thanks, Don. Great job with the presentation. We got a few questions while we were involved in that presentation today, and narrowed it down to about 3 of these. I think we'll have time for today. So let's get started with the first one. When the stock market goes down approximately 25%, how much would a closed-end fund go down?
Well, it depends upon leverage, first of all. And it also depends about, first of all, they're not all stock markets. So it depends on what we mean. We tend to invest mostly in municipal bonds. Closed-end funds trade, tremendous numbers of them trade in municipal bonds. Some trade in MLPs, some trade in real estate, some trade in strategies underneath them, like a call option writing strategy. But it's mostly kind of illiquid assets. The idea here is if you're trading actually a well-diversified stock portfolio, the exchange-traded fund is a better structure to do that with. So there's a limited number of asset classes that you can access with this. So when we say the stock market going down 25%, let's change that to if the municipal bond market goes down 25% and you're in a closed-end fund that trades municipal bonds, how much would we expect that to go down? Wow, probably 50%, probably 50%. The reason is because A, the leverage means that instead of going down 25% like the municipal bonds might have, that would be a huge, huge decline. I'm just talking hypothetically here. It would probably go down closer to 35 or 40% because of the leverage. But then you add on top of that in a crisis, the discount's going to go from maybe 10 or 14% up to 20 or 25%. So when you put all those things together, these closed-end funds can drop 50% in value in a crisis. That's why we need to be patient. because we're never going to pick, the exact day that the discount reaches its maximum. We can't do that. If we waited until a mutual closed-end fund hit a 30% discount, we might have to wait 20 years to see it happen. So instead, we want to pick it up when it's at a 15% discount, let's say, but not invest too much money in it, so that if discounts do widen up to 20% or something like that, we can purchase more of it. Thank you.
Great, great. So next question. If the discount of a fund stays at 15%, how can we make money?
That probably was written before I gave that last answer. And the issue here is, if you can buy the discount at 15%, you're getting the dividends or interest and capital gains on $100, even though you only paid $85 to base on $100. You're buying something at 85 cents in the dollar. And if it stayed at 15% forever, you'd be happy as a clam, because you'd be collecting a lot more. That's before the expenses of the firm. So you want to make sure that the firm has small enough expenses, the fund does, that it makes sense. There are some terrible funds out there that have huge expense ratios, and I wouldn't buy those at any discount, virtually any discount. So if they've got really high expense ratios, you wouldn't want to buy them. But for a good fund like a BlackRock fund, and especially the ones that we recommend, then a 15% discount would be very attractive. And if you knew that it was going to stay 15% for the rest of time, they'd still be fantastic ways to invest your money.
Great, great. Next question. Can I buy closed-end funds of taxable bonds or U.S. government bonds?
Right. I've been talking about municipal funds because they tend to be illiquid, and that tends to be what these closed-end fund structures are useful for, or MLPs, or real estate, or foreign stocks, country-specific stocks. There tend to be a limited number of government bonds. There's one that trades inflation-adjusted treasuries, inflation-linked treasuries. There's some that trade some corporate bonds. Another very popular strategy for closed-end funds is senior loans, because they're illiquid. So closed-end funds are designed to hold illiquid sorts of assets. And corporate bonds and government bonds are rather, and US stocks are rather liquid. So we want to own those through exchange traded funds, and they simply don't issue them because there's no demand for them to have a lot of these closed-end funds hold some of the other sectors that are more common and liquid. So we kind of think of the exchange traded funds to handle the liquid assets like US stocks, corporate bonds, treasuries, and the closed-end funds kind of handle the other asset classes that are less liquid. That's because the closed-end funds were designed to give the company managing the portfolio the freedom to invest in illiquid assets, because they know that the shareholders can't redeem their shares and demand their money back. If somebody wants out of a closed-end fund, they sell their shares in the market. So that's really linked to the whole purpose of these funds, holding somewhat illiquid assets. And as I say, there's some great asset categories, senior loans, municipal bonds, MLPs, and real estate, where these opportunities periodically exist. And I would add to that that these opportunities are not always in cycle with market crises. I've been following these things for 30 years, and it's amazing that sometimes these discounts will simply widen for no apparent reason. And not for a specific fund, it certainly happens a lot. And for the whole class of funds, it'll happen a lot. So when I was going back just really briefly, and this will finish this whole thing, when we looked at the, where is it? Yep, here. When we look at this, all the mutual funds got crazy large discounts, closed-end funds, during the crisis. But sometimes, like these municipal funds would all start to sell at premiums. I remember this vividly. All of the municipal funds were selling at premiums. And it wasn't because municipal funds were that fantastic or the market. It's just a phenomena that tends to occur sometimes. I think it's maybe investor sentiment. And I think that's all we have time for. Adam?
Great, great. Awesome. Well, thank you, Don, for presenting today. We all really appreciate it. Ladies and gentlemen, we want to thank you all for joining us today. If you feel you missed anything today, or there's anything you'd like to listen to over again, we're going to have this webinar available for you to play on demand at builtmorecap.com on our website, as well as links in social media. So follow us on Facebook and LinkedIn, and we'll also email you out a link as well. Feel free to share this webinar with friends or family. If you have any questions regarding your financial situation or these strategies, please give your advisor here at Biltmore a call. We're always here to help. Thanks again for joining us today, and have a wonderful day, everyone.